A lot of people think a reverse mortgage means giving something up. This couple gained something. By the end of the story, they weren't carrying a single credit card balance. Their car was paid off, and their monthly income, the same fixed income they had before, finally felt like enough. Here's how they got there. A couple, both in their late 60s, retired and living on a fixed income here in Oregon. On paper, nothing about their situation looked like a crisis. No single financial fire to put out, but every month the same thing happened. A chunk of their income went straight to minimum payments. A few $1,000s in credit card balances that had crept up over the years, plus a car payment that never seemed to shrink fast enough. It wasn't dramatic, it was just a slow drip, and it changed how retirement felt. Instead of relaxing into it, they were doing quiet math every month. What's left after the payments go out? What can wait? What can't? Here's the part that stood out to me. They still had a mortgage, a modest balance, low enough that they were on pace to pay it off in a couple more years. And keeping that payoff on track was actually a goal of theirs in its own right. But most of what they'd built in that home was already sitting there as equity. The wealth was there, it just wasn't liquid, and it definitely wasn't reachable in a way that showed up in their checking account. When we sat down, their goal was simple to say and hard to solve with the usual tools. They didn't want to refinance their existing mortgage. They were too close to paying it off to want to reset the clock. They didn't want to move, and they were very clear about one thing. They did not want a new required monthly mortgage payment stacked on top of what they had already committed to, like what would happen with a traditional HELOC. They wanted that's the tension that almost every debt payoff conversation runs into. Most tools solve the debt but hand you a new payment in return. For this couple, that would have just been swapping one monthly drain for another, and it would have undone progress they'd already made on their mortgage. Let's walk through why the obvious options were off the table. A HELOC or a cash-out refinance would have gotten them a lump sum, sure, but both come with a required monthly mortgage payment. A cash-out refi in particular would have also reset the clock on their existing mortgage, replacing a loan they were a couple years away from finishing with a brand new one. That kind of defeats the purpose twice over. A personal loan or a 0% balance transfer card wasn't going to cut it either. Not enough available credit to touch both the cards and the auto loan. They needed a lump sum, big enough to clear everything and without disturbing the mortgage they were already so close to paying off. That's a narrow list of tools, and it's exactly where a HomeSafe Second comes in. A HomeSafe Second is a lump sum loan secured by a second lien on the home, sitting behind their existing first mortgage, based on the equity they'd built up. The defining feature, that one that solved their actual problem, is that it doesn't require a monthly mortgage payment. To qualify, they needed to be 55 or older here in Oregon with enough equity in the home and an existing first mortgage already in place. We walked through their numbers, confirmed the equity position, and sized the loan around exactly what they needed. Enough to clear the credit cards and pay off the car loan in full, all while leaving their existing mortgage exactly as it was on the same payoff timeline they'd already been working toward. I want to be clear about something. The loan itself wasn't the goal. It was never about getting a HomeSafe Second. It was the vehicle that got them to the actual goal. Debt freedom without adding a new bill and without losing the ground they'd already gained on their mortgage. So here's where they landed. Credit cards, paid off. Auto loan, paid off. Every one of those minimum payments that used to leave their account automatically every month, without fail, gone. Their existing mortgage kept running on the same schedule, still a couple years from being paid off, untouched by any of this. Their income didn't change. What changed is how far it goes. The money that used to disappear into their debt payments now just stays. It covers groceries, it covers the little things that makes retirement feel like retirement. But honestly, the number isn't really the story. What I noticed with this couple was the shift in how they talked about their finances. Less checking the mail with dread. less doing math at the kitchen table. That's the actual payoff. Not something flashy, just less financial stress every single day. If debt payments are the thing standing between you and a comfortable retirement, this might be worth a conversation. Not a commitment, just a conversation. So you can see your own numbers and whether this tool fits your situation. Book an appointment with me in the link below to see if this might be something for you.